your mortgage, your car loan, your savings account, your retirement portfolio, and even the company that pays your salary are all connected to a market most people never think about. Not the stock market, the bond market. It sounds boring. It sounds like something only banks, governments, and retired people care about. But that is exactly why most people miss it. Bonds are not just another investment. Bonds are how the world prices money. When interest rates move, bonds move. When bonds move, mortgage rates change, business loans change, government debt gets more expensive, retirement portfolios rise or fall. Even the stock market starts to look different because investors are constantly comparing risky returns with what they can earn from safer debt. That means bonds are already affecting your life, whether you own them or not. Most people think getting rich is about finding the next great stock, buying before everyone else, or taking more risk than the average person. But there is another kind of financial power: understanding the cost of money before making decisions with money. By the end of this video, you are going to understand what bonds actually are, why their prices move opposite to interest rates, how they affect your mortgage, your savings, your investments, and why the so-called safe part of a portfolio can still lose money. Because bonds are not boring. They are the hidden math behind almost every financial decision you make. The strange thing about the bond market is that almost nobody talks about it, even though almost everybody lives inside it. People talk about stocks because stocks are visible. They move fast. They make headlines. A company rises 20% in a week. A CEO gives an interview, an index hits a record, and everyone suddenly has an opinion. Bonds move differently. They are quieter, less emotional, less entertaining, but in many ways, they sit underneath everything else. According to SIFMA, global fixed income markets outstanding reached about $145.1 trillion in 2024. That is not a small corner of finance. That is one of the largest financial systems on Earth. Governments use it to fund spending. Companies use it to borrow money. Cities use it to build roads, schools, airports, and hospitals. Banks use it to price loans. Investors use it to measure risk. And that is why ignoring bonds is so expensive. When the bond market decides money should cost more, the effect does not stay on Wall Street. It reaches ordinary people. A family trying to buy a home sees a higher mortgage payment. A business thinking about expansion faces a more expensive loan. A government with trillions in debt has to spend more just to pay interest. A retiree who thought they owned a safe bond fund may open a statement and discover that safe did not mean stable. This is the part most people miss. Bonds are not only investments, they are prices. They tell the world what it costs to borrow, what it costs to wait, what it costs to take risk, and what investors demand in return for lending their money. That is why the bond market can feel invisible until it suddenly touches your life. You may never buy a treasury bond directly. You may never read a bond fund fact sheet. You may never look up the 10-year yield. But if you have a mortgage, a car loan, a savings account, a retirement account, or a job at a company that borrows money, the bond market is already part of your financial life. And once you understand that, bonds stop looking boring. They start looking like the control panel behind the economy. So before we talk about how bonds affect your mortgage, your portfolio, or your savings, we need to understand the basic instrument itself. Because at the center of this $145 trillion machine is one surprisingly simple idea. A bond is just a loan. At the center of every bond is a simple exchange. A borrower needs money today. An investor agrees to lend it. In return, the borrower promises to make interest payments and return the original amount on a future date. That original amount is called the principal. The interest payment is called the coupon. The date when the money is supposed to come back is called the maturity. If you strip away the Wall Street language, a bond is a contract with a calendar attached to it. Imagine buying a bond for $1,000 that pays 4% per year. That means you receive $40 a year while you hold it, and when the bond matures, you expect to get your $1,000 back. Nothing about that sounds dramatic. And if you hold the bond until maturity and the borrower pays as promised, the whole thing can feel very predictable. But the moment you try to understand what the bond is worth before maturity, everything changes. Because bonds trade in a market. And in that market, old bonds have to compete with new bonds every day. Suppose you bought that $1,000 bond paying 4%. Then, A year later, new bonds from similar borrowers are being issued at 6%. Now, a new investor has a choice. They can buy your old bond and receive $40 a year, or they can buy a new bond and receive $60 a year on the same $1,000. Your bond is still paying exactly what it promised. The borrower did not break the contract. The coupon did not disappear. The maturity date did not move. But compared to the new bond, yours is less attractive. So the price has to adjust. The old bond must fall in price until its $40 annual payment becomes competitive with the new market rate. That is the rule that unlocks almost everything about bonds. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. This is not a mood. It is not a prediction. It is not a theory that sometimes applies. It is the basic math of fixed payments competing against new rates. A bond paying $40 a year looks fine when new bonds also pay around $40. But if new bonds pay $60, investors will not pay full price for the older, lower-paying bond. And if new bonds later pay only $25, that same old bond paying $40 suddenly looks valuable, so its price can rise. The payment is fixed. The market price moves. That is the part that confuses people. They hear the word bond and think safety, but there are two different kinds of safety. There is the safety of getting paid back at maturity, assuming the borrower does not default, and there is the stability of the price on your statement before maturity. Those are not the same thing. A U.S. Treasury bond may be extremely strong from a repayment perspective, but if interest rates rise sharply after you buy it, the market value can still drop. The government may still be on track to pay. The bond may still do exactly what it promised. But if you need to sell before maturity, the market may not give you the price you paid. This becomes even more important with bond funds. An individual bond has a maturity date. A fund usually does not. A bond fund owns many bonds, constantly buying, selling, replacing, and rebalancing them. So when rates rise, the value of the fund can fall, and there is no single date where the entire fund simply matures and hands back one fixed principal amount to every investor. That is why someone can own a safe bond fund and still see a loss. The borrower may be safe. The price may not be. There is also a number that tells you how sensitive a bond or bond fund is to interest rate changes. It is called duration. You do not need to master the full formula to understand the danger. A higher duration means the price is more sensitive when rates move. A lower duration means the price usually reacts less. A short-term bond fund might move modestly when rates change. A long-term bond fund can swing much harder. Two investors can both say they own bonds, but one may be holding something stable and short-term while the other is holding something that can fall dramatically when rates rise. Same category, completely different risk. And this is where bonds become powerful to understand. The instrument itself is simple. The danger comes from assuming every bond behaves the same way. A bond is not automatically safe just because it is called a bond. You need to know who borrowed the money, when you get paid back, how much interest it pays, what rates have done since it was issued, and how sensitive the price is to the next move in the market. Once you understand that, the mystery disappears. The bond market is not random noise. It is millions of fixed payments being repriced as interest rates change, and the rule is always waiting underneath the surface. Higher rates punish old bonds, lower rates reward them. For decades, investors were taught a very simple story. Stocks are the growth engine. Bonds are the protection. If the market gets rough, the stock side may shake, but the bond side is supposed to soften the damage. That idea became so familiar that millions of people built their retirement accounts around it. The classic version was the 60-40 portfolio, 60% stocks, 40% bonds. Not aggressive, not reckless, sensible, balanced, conservative. Then 2022 happened. Inflation surged, the Federal Reserve raised interest rates at one of the fastest speeds in decades, and the bond market was forced to reprice almost everything. The rule we just covered did exactly what it was supposed to do. Rates went up and existing bond prices went down. But the size of the damage shocked people. The broad U.S. bond market, measured by the Bloomberg U.S. Aggregate Bond Index, fell about 13% in 2022, one of the worst years in its history. At the same time, stocks were also falling. So the part of the portfolio that was supposed to act like a cushion suddenly dropped alongside the part that was supposed to be risky. That is why 2022 was so painful. It did not just hurt aggressive investors. It hurt people who thought they were being careful. Imagine a retiree opening her account statement. She expected the stock portion to be volatile. She understood that. But the bond fund? That was supposed to be the calm part, the stabilizer, the place where money went when she wanted less risk. And yet, there it was. A real loss in the part of the portfolio she had been told was safe. The mistake was not owning bonds. The mistake was owning bonds without understanding what kind of risk was inside them. A bond can be reliable in one way and risky in another. A treasury bond may have very low default risk because the US government is considered one of the strongest borrowers in the world. But if that bond has a long maturity and interest rates rise sharply, its market price can still fall hard. That distinction matters. Credit risk is the risk that the borrower does not pay you back. Interest rate risk is the risk that your bond loses market value because new bonds now pay more. Many investors thought they were avoiding risk because they owned high-quality bonds, but they were still exposed to interest rate risk, and in 2022, that was the risk that mattered most. Duration made the difference. A short-term bond fund may move only modestly when rates rise. A longer-term bond fund can fall much more. And an extremely long-duration bond can behave almost nothing like the calm investment people imagine when they hear the word bond. The longer you lock in a fixed payment, the more sensitive that bond becomes when the market rate changes. That is why two people can both say, "I own bonds," and have completely different experiences. One person may own short-term treasury bills that mature quickly and adjust to new rates. Another may own a long-term bond fund filled with bonds that do not mature for decades. On paper, both are in fixed income. In real life, one may feel like the parking money, while the other can swing like a risky asset when rates move. This is also why bond funds confuse so many people. If you buy one individual bond and hold it until maturity and the borrower pays as promised, the price movements along the way may not matter much to you. You receive the interest, wait for the maturity date, and get the principal back. But a bond fund is different. A fund owns a rotating basket of bonds. It does not have one clean maturity date where every investor simply receives one fixed principal amount back. So when rates rise, the value of that basket gets marked down. The loss appears on your statement. And suddenly, the thing you thought was there to protect you starts acting like something you never fully understood. That is the lesson from 2022. Bonds did not stop working. The math worked perfectly. The problem was that millions of investors had been given a slogan instead of an explanation. They were told bonds were safe, but they were not taught safe from what? Safe from default? Maybe. Safe from price declines? Not always. Safe over 1 year? Not necessarily. Safe if held to maturity? Sometimes, depending on the bond. Safe inside a fund? That depends on duration, rates, and the structure of the fund. One word was doing too much work. Safe. And when one word replaces understanding, people get surprised by risks that were visible the entire time. So the lesson is not to avoid bonds. The lesson is to stop treating bonds as one simple category. A 3-month treasury bill, a 10-year treasury note, a 30-year bond, a high-yield corporate bond, and a long-duration bond fund are not the same instrument just because they all live under the same label. They respond differently. They carry different risks. They serve different purposes. And if you understand that, 2022 stops looking like a mystery. It becomes a warning. Not that bonds are broken, but that safe is not a strategy. Understanding what you own is. Once you understand the basic rule of bonds, the financial world stops looking like a collection of separate events. A mortgage rate is no longer just a number from a bank. A savings account is no longer just a place where cash sits. A company laying off workers is no longer just a business headline. A stock market sell-off is no longer just investors panicking for no reason. Behind all of those things, there is usually one question being answered again and again. What does money cost right now? That is what bonds reveal. When a bank offers a mortgage, it is not starting from zero. It is looking at the wider interest rate environment and comparing your loan to what it could earn somewhere else with less risk. If government debt is paying more, your mortgage has to pay more too. That is why the same house can feel affordable in 1 year and completely out of reach in another. The house did not change. The borrower may not have changed. the price of money changed, the same thing happens with cash. When safe short-term instruments are paying meaningful interest, leaving money in an account that pays almost nothing becomes more expensive than it looks. The balance may not be falling, but opportunity is leaking out quietly. Most people only notice risk when money disappears from the account, but sometimes the cost is what the money could have earned somewhere else. Businesses feel this pressure even more directly. When borrowing is cheap, companies can expand, hire, refinance debt, open new locations, invest in equipment, and take bigger risks. When borrowing becomes expensive, the entire mood changes. Expansion slows. Debt becomes heavier. New projects get delayed. Hiring becomes more cautious. A company that looked strong when money was cheap can suddenly look fragile when every dollar borrowed comes with a higher price. And stocks are connected to the same system. Investors are always comparing choices. If safe bonds pay very little, stocks can look more attractive because there are fewer good alternatives. But when bond yields rise, the comparison becomes harder. Suddenly, investors can earn a real return without taking as much risk. That does not mean stocks automatically collapse, but it does mean stocks have to compete against a stronger alternative. This is why bonds explain so much more than people expect. They influence what families pay to borrow. They influence what savers earn on cash. They influence how companies spend, hire, and survive. They influence how investors value stocks. They even influence government budgets because when rates rise, the cost of servicing debt rises with them. Bonds are not sitting quietly in the background. They are constantly translating time, risk, trust, and fear into numbers. When investors are calm, risky borrowers can often borrow more easily. When fear rises, money runs towards safer places. When corporate bond spreads widen, the market is demanding more reward for lending to companies. When the yield curve changes shape, investors may be signaling what they expect from the economy, inflation, and future interest rates. None of these signals are perfect. The bond market can be wrong. Investors can overreact. Rates can move for reasons that are hard to understand in the moment. But ignoring the bond market completely means ignoring one of the clearest windows into how money is being priced. And that is the real shift. Once you understand bonds, you stop reacting to financial life like everything is random. You begin to see the connections. You understand why a mortgage payment jumped, why a bond fund fell, why cash suddenly earns more, why stocks feel pressure when yields rise, why companies with too much debt become vulnerable when rates move against them. You stop seeing interest rates as background noise. You start seeing them as the price tag attached to almost every financial decision. That is why bonds are not just for retirees. They are not just the conservative part of a portfolio. They are not just boring investments people buy when they are afraid of stocks. Bonds are the language of money. They tell you what lenders demand, what borrowers pay, what investors fear, and what the economy is starting to feel before the headlines fully catch up. And once you understand that language, money becomes much easier to read. You may not predict every market move. You may not know exactly where rates go next. But you will no longer look at mortgages, savings accounts, bond funds, corporate debt, and stock valuations as separate worlds. You will see the connection running underneath all of them. That connection is the cost of money. And the people who understand the cost of money make clearer decisions with the money they already have. So remember this: bonds are not boring. Bonds are not invisible. Bonds are not just the safe corner of finance. Bonds are the price tag on money. And once you understand the price of money, every financial decision becomes clearer. If this video helped you understand bonds in a new way, subscribe to the channel, because this is exactly the kind of financial education most people never receive, but everyone should understand.